Somewhere in Australia today, someone earning $45,000 a year is following the exact same financial playbook as someone earning $180,000. And that's a massive problem because a strategy that makes perfect sense at $45,000, like chasing every government incentive and aggressively paying down debt, becomes a missed opportunity at $180,000, where tax minimization and investment structures should be doing the heavy lifting. And the advanced moves that save a high earner tens of thousands are either unavailable or completely irrelevant if you're still building your foundation. Your income level determines your best next move, and most people get this wrong. So today, I'm going to walk you through the best financial strategies based on what you actually earn. By the end of this video, you'll know the exact moves to make at your income level right now in Australia. Let's start with the foundation. In the 2025 to 2026 financial year, Australia's tax brackets look like this. You pay nothing on the first $18,200 you earn. From $18,201 to $45,000, you're taxed at 16 cents per dollar. Between $45,001 and $135,000, the rate jumps to 30 cents. From $135,001 to $190,000, you're paying 37 cents. And anything above $190,000 gets taxed at 45 cents on the dollar, plus the 2% Medicare levy on top of everything. Now, if you're earning under $50,000 a year, your number one priority is building a financial floor beneath you. That means an emergency fund, 3 months of essential expenses in a high-interest savings account. This single move stops you from going into debt when life throws a curveball, which it always does. At this income level, the government actually wants to help you build wealth, and most people don't even know about it. It's called the Super contribution. If your total income is $47,488 or less in 2025 to 26 and you make a personal after-tax contribution of $1,000 into your super, the government will match it with up to $500. That's a 50% return on your money instantly. You won't find that anywhere else. There's another one called the Low Income Superannuation Tax Offset. If you earn $37,000 or less, the government will refund up to $500 of the tax paid on your employer's super contributions. These two tools alone can add tens of thousands to your retirement balance over time because of compound growth, and they cost you almost nothing to activate. At this stage, debt is the silent wealth destroyer. If you're carrying credit card balances or buy now, pay later debt, every dollar of interest is pulling you backward. Use the avalanche method. List your debts from highest interest rate to lowest. Throw everything extra at the top one while paying minimums on the rest. Once the first debt is gone, roll that payment into the next. This approach saves you the most money in interest over time. Now let's move up. If you're earning between $50,000 and $100,000, you're in what's called the leverage zone. You've got enough income to make meaningful moves, but you're not yet in the higher tax brackets where advanced strategies kick in. This is where salary sacrifice becomes your best friend. Here's how it works. Instead of receiving all your pay as take-home income, you direct a portion of your pre-tax salary into your super fund. That money gets taxed at just 15% inside super instead of your marginal rate of 30% or more. The concessional contributions cap for 2025 to 26 is $30,000 per year, and that includes the 12% your employer is already putting in. So if your employer contributes $9,000, you can salary sacrifice up to $21,000 more before hitting the cap. But here's a detail most people miss. If you didn't max out your concessional cap in previous years and your total super balance was under $500,000 on June 30th last year, you can carry forward those unused amounts for up to 5 years. That means in a single year you could potentially contribute well above $30,000 and claim a much larger tax deduction. This is also the income range where you should seriously consider the First Home Super Saver scheme. If you haven't bought property yet, you can make voluntary contributions into your super of up to $15,000 per year and $50,000 total, then withdraw those contributions plus deemed earnings to put toward a home deposit. At this income level, investing outside of super should also start. Even $200 a month into a diversified Australian ETF like VAS or a global option like VDHG starts compounding seriously over 10 to 15 years. All right, now if you're earning between $100,000 and $150,000, the game changes. You're now firmly in the 30% bracket and approaching the 37% bracket at $135,001. Every extra dollar of taxable income reduction has a real impact. Salary sacrifice is still essential here, but you should also be looking at your deductions more carefully. Work-related expenses, self-education costs tied to your current employment, and home office expenses if you work remotely all reduce your taxable income. At this income level, private health insurance becomes a financial decision, not just a health one. If you earn over $101,000 as a single or $202,000 as a couple, and you don't hold private hospital cover, you'll pay the Medicare levy surcharge on top of the standard 2% Medicare levy. That surcharge starts at 1% and goes up to 1.5%. In many cases, a basic hospital policy costs less than the surcharge itself, so you're actually saving money by holding the cover. This is also where you start thinking about investment structures. A straightforward share portfolio or property investment using negative gearing can be powerful at this tax rate. When you borrow to invest in property and the costs exceed the rental income, that loss offsets your taxable income. At a 30% or 37% marginal rate, the tax benefit is significant. If you hold investments for more than 12 months, you get a 50% discount on any capital gains. So timing your sales matters. This is basic, but so many people ignore it and sell assets too early, paying double the tax they needed to. And then there's the top tier. If you're earning $150,000 or more, you're in the territory where every strategy needs to be deliberate and coordinated. At $190,001 and above, the government takes 45 cents of every extra dollar plus the 2% Medicare levy. That's 47 cents gone before you see it. So reducing taxable income isn't optional, it's essential. Maximizing your super contributions through salary sacrifice is non-negotiable at this level. You should be hitting the $30,000 cap every year, using carry-forward provisions if you have them, and looking at spousal contributions if your partner earns less. Contributing to a lower earning spouse's super can trigger a tax offset of up to $540, while also balancing your household's retirement savings. Beyond super, high earners should explore investment bonds, which are taxed internally at a maximum of 30% and become completely tax-free after 10 years if you follow the 125% contribution rule. Family trusts can distribute investment income to family members in lower tax brackets, though they come with compliance costs, so they need to make sense for your situation. Franking credits from Australian shares are another tool. When you own shares in companies that have already paid corporate tax on their profits, those tax credits flow through to you and reduce your personal tax bill or even generate a refund. The single biggest mistake high earners make is lifestyle inflation. Earning $200,000 means nothing if you're spending $195,000. The gap between what you earn and what you keep is the only number that matters. Set a savings rate target of at least 20 to 30% of your gross income and automate it. Pay yourself first, invest the difference, and let time do the heavy lifting. No matter where you sit on the income scale, here's the truth. Wealth isn't built by earning more. It's built by keeping more of what you earn and putting it to work in the right places. The strategies change as your income grows, but the discipline stays the same. If this video gave you even one idea you can use today, smash that like button, share it with someone who needs to hear it, and subscribe to the channel. Thanks for watching, and I'll see you in the next one.